Borrowing money for 30 years now costs the U.S. government more than at any point since 2007. And because U.S. Treasury rates help set borrowing costs around the world, that rise is also being closely watched across Asia. And a 30-year U.S. Treasury yield recently hit 5.34% for its highest since 2007. It has eased to about 5.2% after Treasury Secretary Scott Bessent doubled planned buybacks of longer-dated government debt to at least $4 billion per operation in a bid to ease pressure on the bond markets. We saw some of the link play out in Asia last week. Regional bond yields tracked U.S. Treasuries higher and then eased as U.S. yields pulled back. Crucially, analysts at Japanese banking giant MUFG noted that Asian financial conditions have yet to show signs of broad tightening. But higher U.S. yields can still put pressure on Asian currencies, widens the interest rate gap between the U.S. and Asia, pulling global capital into dollar-denominated assets and pressuring regional currencies like the Japanese yen, South Korean won, the Indonesian rupiah as well. And that can put Asian central banks in a bind, because they may be forced to keep domestic rates higher for longer just to defend their currencies, even if their local economies need rate cuts to support growth. There is also a longer-term debt effect. Higher global borrowing costs can make it more expensive for governments and companies to refinance their existing debt, potentially leaving less room for investment and spending. But analysts say that for Asia, the question is not how high U.S. yields can climb. It's what's driving the surge. If higher yields stem from expectations of tighter Fed policy while U.S. and global growth slow, and Asia faces a twin squeeze. But if yields are rising because investors expect stronger U.S. growth, then resilient export demand helps Asian economies absorb the higher rates. And for more, we're joined by Ilian Mihov, Professor of Economics at INSEAD. So appreciate you joining us this morning.
Thank you.
I'd like to focus, of course, on this increasingly volatile bond markets globally is what we're seeing. How high are the stakes for Kevin Walsh at Jackson Hole, especially given expectations that he's not going to be giving investors any sort of clues that, the markets have been so used to for so long?
Yeah. Well, the stakes are pretty high because we're entering now a few weeks of very important data releases with a lot of information coming in. We'll see the effects of the intervention on the bond market, but also what is very important for Kevin Walsh is what the labor market report says next week, so the employment situation report. And the reason that this is important is because in the last year, so if you look at the US employment data for the last 50, 60 years, we have never seen a flat curve like we see today. So for the last year and a half, the US economy has created about 300, 400,000 jobs, which is very low. And not only this, but you see positive number, negative number, revision, positive number, negative number. Most of the time, if not most of the time, actually throughout the entire history since 1946, if you see more than 2 consecutive negative numbers, it's been all in recession. So the labor market is stagnating. On the one side, you have weaknesses that you see there. We talk about the consumer and so on. On the other side, you have the inflation situation, which is still stuck at 3% plus, and that's obviously a key issue. Now, the Bessent intervention is creating an additional problem because normally, this is monetary policy intervention. That's what central banks do. They start buying debt of one maturity, maybe switching to another maturity. And it seems that that will create another set of questions. To me, to be honest, I'm a little bit puzzled why the Fed did not do that. I think that they should have agreed, because the effect of what Bessent is doing, most people think it's minimal. We can even look back at the data because in 2011-12, the Fed did this Operation Twist, the maturity extension program, where they intervened with $670 billion, $667 billion. They intervened on the market, basically doing the same thing, buying long-term debt and exchanging it for short-term debt.
Yeah.
In order to lower mortgage rates, in order to make houses more affordable, which I guess is the reason now. So if many people think that that was not effective, still, there are estimates that put the effect on long-term rates of about reduction of 0.1 to 0.15%, so 10 to 15 basis points. That was 670 billion. Now, the total operation of Bessent is expected to be about 33, 35 billion because it's 4 billion for several weeks. So it's 20 times smaller. You have 20 times smaller intervention. The big intervention changes by 10, 15 basis points. What will be this change? I don't think that it will be very effective.
What are your suspicions for why Bessent is doing that, knowing that, the underlying issues, first of all, are not being taken care of, and these are just short-term measures? We saw how yields rebounded very quickly, almost overnight, when he announced the move.
Yeah. I think it's a bit of a political move. It's probably trying somehow to lower the signal that they want to lower the long-term rates because of mortgages. In the US, we know that mortgage rates are now very high. There is slowing demand for housing, and I guess some people are complaining to President Trump or to others that the houses are not affordable with these interest rates. So they're trying to intervene, but I don't think that will be a successful intervention.
Yeah, I just want to build on that because realistically for the US, can it bring down debt levels without, imposing spending cuts or higher taxes? I mean, this is obviously, or if I may just wager a guess, it's got something to do with the midterms.
Yeah, I think it's exactly, it has to do something with the midterms because, at the end of the day, we are not only in the US, but in many countries, we're on such a dangerous trajectory. If you look at the debt to GDP ratio, so most people say, we crossed 40 trillion, and it's kind of like an interesting benchmark, 40 trillion. But what really matters is the ratio of debt to GDP, because at the end of the day, you're paying your taxes out of GDP. So if GDP is growing very fast, you may have a lot of debt, but it's basically shrinking.
Yeah.
So to reduce this debt to GDP ratio, which is now 120%, you have to cut spending, which nobody wants to do exactly the opposite. You have to increase taxes, which nobody wants to do. You have tax cuts all over the world. You can have lower interest rates, which again, we're going in the opposite direction now. That is the numerator. The denominator is basically, you can have faster growth. So everybody's expecting, we'll get an amazing, productivity growth and so on. But I want to remind people that if you look at the history of the United States from 19th century to today, GDP, income per capita growth, the speed of the economy has been roughly constant at 1.8%. And, electricity came, engines with internal combustion, flying, computers, 1.8% growth. So this number is not going to be increased. The other number that is in the denominator, which is important, is inflation. And I think that will be the main way to reduce debt to GDP ratio because you have nominal GDP. So if it grows very fast, your burden goes down. And the third factor there is population, because you can grow your GDP per capita at 1.8%, but if you have more people, you have more GDP. Yeah. And that's where actually the US is going again in the opposite direction, with actually population growth being quite slow, being zero.
I do want to squeeze in one more question on, this sort of fiscal problems, not just in the US, because this is playing out here in Asia, as you alluded, as well, other parts of the world. UK, Andy Burnham, France, Japan, Japan in particular, has plans for significant government spending despite elevated debt. I mean, what does it say about this as, the nature of this as a fiscal problem? And at what point do these higher sovereign yields actually become economically damaging?
Well, I think they already are becoming economically damaging, going at 5.3%, 5.5% we have seen before, but the increase in an economy, especially in the US now, people say, productivity will improve and so on, but it's not improving yet. I mean, we don't see it in the numbers at all. To the contrary, the main measure of productivity is going down. And I think that now this will raise the cost for all these data centers, the other investment, but you need to do also other investment, not just data centers. So the big companies like Amazon and Google, they can find money, but then what about the others? I think it's still the conditions are not bad. I think that actually there's still availability of funding and so on, but it starts increasing. And I think that one of the really interesting facts, if you look at across countries, is that the spreads between this increasing corporate debt and government debt are very small, which tells me that the market is worried more about government sustainability rather than previously, you'll see the spreads increasing before crisis because the corporate debt is too much and so on. Now we see that probably the market is more worried about the sustainability of government debt, and it will start becoming damaging.
All right. We appreciate you joining us today and breaking this all down. Ilian Mihov, there, Professor of Economics at INSEAD.